Hello, everyone, and welcome. We're happy to have you with us today. My name is Carrie Ferg, and I'm your host for Manta's Small Business Expert Series about sales tax basics. Manta wants to thank sales and use tax expert Mark Giddens for generously donating his time and expertise. We hope you'll tweet about today's event using hashtag MantaExperts. We'll begin today with a welcome from Manta CEO, John Swansinger. Here's John.
Sales tax is hard to master and a topic that's not popular among small business owners. However, it's essential for small business owners to understand sales and use tax compliance to avoid potentially costly scrutiny from auditors. I would like to welcome special guest Mark Giddens today. He's a founding employee of Avalara, a leading sales tax software company, and he has worked in sales and use tax management for more than 15 years. Today, he's going to teach you the big difference between sales tax and use tax, and the critical questions to determine if you have Nexus. You'll also gain a greater understanding about how technology is impacting the sales tax landscape and tips on how to avoid a sales tax audit. Thanks for attending our expert webinar today. Now, back to Carrie.
Thanks, John. In case you missed it earlier, I'm Carrie Ferg, editor at Manta, and your host for today's webinar. I want to take a few minutes to cover some important housekeeping items about the event. Let's first talk about your screen. During the webinar, you should see a slide area which you can resize and make bigger. Left of that is the media player, and under it is a box called the resource list and some widgets. All of the widgets open and close, and I encourage you to check them out. I want to point out 3 widgets in particular: the resource list, the help widget, and the Q&A widget. The resource list is open under the media player. I'll be referring to the resource list often during our event today because you'll find links and documents there that you can open and explore while we're talking. If you're having technical difficulties, please click on the help widget, the one with the question mark icon. My colleague Mel is answering your technical questions, so just send her a note. Now I'd like to introduce Graham, our community manager, who will be fielding your questions today.
Hello, everyone. I'm Graham, the community manager here at Manta. I'll be helping with questions today. I know you'll have a lot of questions about our content once we get going, so ask them anytime. Just click on the Q&A widget and type in your question, and I'll push them along to Carrie and our expert, Mark. Carrie and Mark will be answering questions during the last 15 minutes of the webinar, but please ask them as soon as you think of them. Also, after the webinar, I'll be hosting a discussion with Mark and our community. Join us, and Mark will will answer any lingering questions you have about sales and use tax.
Thanks, Graham. Okay, let's get down to business. I'd like to start today's webinar with a story about why we're here. Sales tax is an important source of state revenue, making up 47% of total state revenue. However, with more than 12,000 taxing jurisdictions throughout the United States, sales and use tax compliance is a complex topic for small business owners to master, as well as time-consuming and non-revenue generating. Not to mention the rules are always in flux. In 2014 alone, there were close to 14,000 rule changes. And according to Wakefield Research, the average total cost for businesses to manage a sales tax audit is $114,000. In fact, 48% of businesses believe that an auditor would find a mistake. So that's why we're here today, to talk with our expert to drill down into the basics of sales and use tax compliance. Here's what we have planned. First, you'll meet today's expert, Mark Giddens. Then Mark is going to guide us through the difference between sales and use tax and how to determine Nexus. He'll also give us an overview of technology's impact on sales tax, as well as tips on how to avoid sales tax audits. Thanks for joining us today, Mark. We'll do a couple of polls because we want your opinions, and we'll take your questions in the last 15 minutes or so. Ask your questions using the Q&A widget anytime during the webinar. Mark Giddens is one of Avalara's founding employees and has worked in accounting and sales and use tax management for over 16 years. He is Director in technology expert at Avalara. Click on the speaker widget in your console to learn more about Mark. Now I'm going to pull up a quick poll. The question is, how much time does your organization spend each week managing sales and use tax compliance? I'll wait several seconds and then I'll pull up the results. Looks like the majority of you are spending 0 to 4 hours a week managing sales and use tax compliance. So Mark, let's get started. Can you walk us through the difference between sales and use taxes?
Absolutely, and thanks for the introduction, Carrie. I'm excited to meet with all you today. Thanks for joining our event. When you look at sales taxes and use taxes, there's some confusion out there. And when we talk to businesses, sometimes they call everything sales tax. Sales tax is actually an intrastate transaction. So if I were to walk across the street to the grocery store and I want to buy a water bottle, that's occurring within the state's boundaries. That's a sales tax transaction, and sales tax is collected. In states as well, if I were to buy that same water bottle, let's say from Amazon, and they ship it from Seattle to my office in Bainbridge Island, it would still be a sales tax transaction. But there's a different type of tax that comes into play when I'm buying from an out-of-state vendor. If I buy that water bottle, let's say from a company that's in Texas, if they have Nexus, and we'll talk about that a little bit later as far as what Nexus is, and we'll broaden out that topic, but if they have Nexus in Washington, and they sell me that water bottle, they're compelled to collect the tax. That tax is called a seller's use tax. Now, that very same transaction, if I buy a water bottle from a Texas company, they ship it to Washington, and they don't have Nexus, meaning because of that they haven't registered to collect tax, they're going to collect zero tax, and it's on me as the buyer. So whether I'm a business or a consumer, when I'm buying things from out-of-state vendors, it's up to me to self-assess and pay the appropriate taxes directly to the government. So again, we have sales tax, which is an intrastate transaction. Use tax is typically an interstate transaction, and again, that occurs depending on whether the seller has Nexus. If they have Nexus, they're going to collect the tax, and that's called a seller's use tax. If they don't collect tax because they don't have Nexus, then again, it's on me as the buyer to self-assess and pay that to the appropriate tax agencies.
Thanks, Mark. So sometimes small business owners are exempt from paying sales tax, right? How are exemptions determined? What about use tax? Are consumers ever exempt from paying that?
Yeah, so let's talk a little bit about exemptions. There's different types of exemptions out there. When you look at customers, one type of exemption is a entity-based exemption. And that would be when an organization is defined by a state by nature of their organization that they're exempt from paying sales tax. So in many states, for example, nonprofits or hospitals or schools and educational organizations are defined as exempt, so that's an entity-based exemption. Now, one thing to be aware of is that those exemptions are not uniform across states. Like most things sales tax, there's quite a bit of variance state to state. So in the case of an entity-based exemption, that's based on the nature of the organization. The other type of exemption that we see, which is common, is actually a usage-based exemption. And when you talk about a usage-based exemption, this is where an organization is buying something, and normally that item is taxable, but by nature of the use of it, it's being used in an exempt manner. So what I mean by that is common in the supply chain, right? Let's say I'm a wholesaler, and I'm buying something from a manufacturer, and I'm going to go ahead and turn it around and sell it to a distributor. The nature of my use of the product, I'm buying it as is, but I'm turning around and selling it to someone else, means that I'm exempt from sales tax. The same is true, there's manufacturing exemptions if I'm buying materials to use in a manufacturing process. In the U.S. tax system, we base the tax at the point that the end user takes possession of the goods or the service from a tax perspective. Now, one of the challenges about customer-based exemptions and entity-based exemptions is the onus is on the seller to actually be able to prove that. So if I'm selling to an exempt organization as a seller, if I have Nexus in that state, I'm required to collect the appropriate documentation, the resale or exemption certificate that I can produce in the event of an audit. This is an area where auditors are focusing more of their efforts because, certainly if companies aren't collecting tax and they're not able to prove that that sale was exempt, that's a way for states to increase their revenues. But that can be pretty dangerous. When we think about managing certificates, a lot of companies think about it like managing paper. But I remember a story one of our customers told us, Northern Tool, prior to using Avalara's service, they were missing a certificate in a sales tax audit, and that one piece of paper that they were missing was going to cost them upwards of $20,000 in fines, penalties, and interest. And so they went through extraordinary efforts to collect a certificate from a business that's ownership had changed. But the mindset out there when we talk to companies is it's kind of shifting. People are not so much thinking about managing certificates as they're managing paper, but because there's a value to those pieces of paper, people are thinking about them more so as currency.
Thanks, Mark. Let's move on to Nexus now. What does Nexus mean exactly?
Well, Nexus means substantial physical presence, and that stems back from a landmark court case in 1992, Quill Corporation versus the state of North Dakota. And basically what happened is Quill Corporation was a catalog company, and they were selling all over the United States. They were sending catalogs out, and they were selling office supplies via the mail. And the state of North Dakota came after Quill because they said North Dakota has a sales and use tax. Our businesses and consumers are required to pay that. Quill Corporation, you should be collecting it, and in fact, you should have been collecting it for a while now. You owe us tax money. And Quill Corporation lawyered up. They went to court. And this case went all the way through the state system, all the way to the Supreme Court. And in the Supreme Court case, the court was kind of deciding out, an answer between two different, competing arguments. One is, what is the state's rights to enforce tax collection within their borders? Because this is a tax on North Dakota businesses and consumers. It's not a tax directly on Quill per se. But on the other hand, Quill's argument was, we're a small company. If we had to hire tax people to manage tens of thousands of jurisdictions to manage the taxes everywhere we send a catalog, it would kill our profitability, probably put us out of business. And so what the Supreme Court said very specifically was, in their ruling, is unless a company has created a substantial physical presence, they can't be compelled to be the collector of the tax. Now, one of the challenges with that, Carrie, is that while the Supreme Court said Nexus is a substantial physical presence, and if you don't have it, you don't need to collect taxes, they didn't say what defines a substantial physical presence. So that falls back to state statutes, and that can vary quite a bit. Most people know that owning real property is a Nexus trigger in a state. So if you have a brick and mortar location or you have a headquarters or you lease or own real property, that's a Nexus creating activity. But there's a whole host of other things that can create Nexus, a lot of times things that companies aren't so aware of.
Which is a great opportunity to ask another poll question. Do you feel confident you are registered in all of the states in which you have Nexus? Give it a couple more seconds here, and then we'll pull up the results. Okay, so that's almost a 50-50 split. Mark, is it true in recent years how Nexus is determined has continued to change? Can you explain some of those changes?
Absolutely. So we talked about this Quill Corporation case versus North Dakota, and that's been the precedent that companies look to in terms of determining where they're required to collect taxes. But put this into some context, the economy's changed since 1992, and now much of what we used to buy in stores or in the mail is happening online. And so National Retail Federation did a study, and they found that the amount of uncollected tax due to internet sales, remote sales occurring over the web, was $24 billion. That's $24 billion with a B. And the loophole that exists is states have sales and use tax laws, but as remote sellers sell into states where they don't have Nexus, certainly they're not collecting that tax. And if you depend on the consumer to go ahead and self-assess and pay the tax, what the study shows, it simply doesn't happen. So states are trying to broaden the tax base, and what they're trying to do is to put the onus more so on the seller than on the buyer in terms of paying the taxes. Now, there's a whole host of activities that are happening at the state level and at the federal level to kind of broaden that base of collection. One of the things that we've seen is that the state of New York passed a law several years ago called a click-through nexus law. And what they did is they said that companies that have affiliate programs, like Amazon, for example, that have partners referring business to their website. So, a New York business or resident has a banner ad on their site or a link on their blog to direct traffic to Amazon, and in a e-tailer like Amazon pays a commission for that sale. That not only is it, it's not necessarily that Amazon has a nexus because they don't have a warehouse or employees or things like that, but by nature of the relationship with that affiliate in New York, that is now considered nexus as well. And what you see is that several other states have passed similar laws. You saw California, Illinois, Colorado, Florida, several other states jump on board with these types of laws at a state level targeting e-commerce retailers for doing the tax collection. It's happening at the federal level as well, and we'll talk a little bit about some of these nexus-creating activities, but there's several bills being talked about in the Congress now. There's the Marketplace Fairness Act, there's the Remote Transaction Parity Act, and there's the Online Sales Tax Simplification Act that all stand to increase the amount of tax collected by online retailers because of this use tax loophole that exists. And if you thought the courts were going to come to your rescue, they've kind of changed their tune. Recently on a sales tax case that they decided related to the Department of Revenue in Colorado, remarks were made that this Quill Corporation decision may have been dated, and if it were evaluated today, they might have come up with a different ruling. Some of the justices feel that the ruling was flawed to begin with. So, if you'd like, Carrie, I can run through some of these activities because there's quite a bit of difference and variance state to state, but there's a whole host of activities that can be nexus triggers.
Yeah, I think it would be good just to highlight sort of the range of nexus-creating activities.
Excellent. So certainly if you own or lease real property, if you have multi-state locations, that is a nexus trigger. But beyond owning or leasing real property, there's several other things that companies need to think about. Traveling into states, for example, to perform maintenance or installation or repair services can be a nexus-creating event. Performing deliveries into a state via a company vehicle can be a nexus-creating activity. Tangible property ownership can be a nexus-creating activity as well. Nowadays, we see a trend for smaller e-commerce companies to be able to provide fast shipping for their clients. They're contracting with companies like Amazon. For example, with Fulfillment by Amazon, Amazon will store your inventory in their warehouse, and they'll ship it on your behalf, but you still own that inventory. So theoretically, if I'm using Fulfillment by Amazon and it's my inventory in their warehouses, I'm creating nexus in those locations that Amazon stores my stuff. Sales-focused activities tend to be a nexus trigger as well. Traveling into a state for the purpose of establishing a market, soliciting sales, meeting with customers, partners, potential customers can be a nexus-creating event. Even going to attend trade shows, in some states being an exhibitor at a trade show is enough to constitute a nexus. In some states, just attending a trade show or a certain amount of trade shows over the course of a calendar year can be a nexus-creating event. And some companies think, this necessarily doesn't apply to me because while we have salespeople, they're not our employees, they're 1099 employees, or maybe they represent more products than just mine. They're a manufacturer sales agent. But if you have a contract employee doing sales, that could be a nexus trigger as well. Even things like traveling, sending investors or board members into a state for a board meeting could be enough to create nexus in a particular state. So this is certainly not an exhaustive list. It gives you an idea, though, of the activities that can create a connection with the state, and based on the state statutes, depending on the state, that could create that substantial connection that you have that requires you to register and then collect taxes.
Thanks, Mark. That's really helpful. And I want to remind you all, if you have questions, submit them through the Q&A widget, and we'll try to answer them at the end of the event. And if not there, we'll be answering on the community as well. So let's move on to jurisdictions. Mark, with more than 12,000 tax jurisdictions out there, can you explain how jurisdictions are created? Is it by zip code?
Well, that's a challenging question, because if you look at this picture of the map that we have there, that little satellite photo, this is an actual zip code within Greenwood Village, Colorado. So all the area in that little picture is within one zip code. But you can see here there's 4 different crisscrossing jurisdictions within this border. And certainly in the U.S. we have state taxes, but we also have county taxes, city taxes. We have special taxing districts. Those don't necessarily follow zip code lines. When you look at special districts especially, these are the districts that are created for police funding in Alabama, or you have the Bay Area Rapid Transit Tax in Northern California, or the Community Improvement District in downtown Columbia, Missouri. These lines don't necessarily match up with zip codes, and for the most part, they tend to match up with where the money's at. But when there's a ballot measure and a new tax is passed, there's a legal definition of the area that applies to. And again, that doesn't necessarily map to zip codes. Companies that use zip codes to assign tax run into challenges because if they're overcharging the tax, they're creating, at minimum, customer service issues with their customers. In this picture here, the tax rate between those jurisdictions actually ranges, I think it's about 4.5% to close to 8%. So that could be a significant issue for your client. Maybe they call you up and want you to fix the tax or refund them the tax that they've paid. If you're selling expensive items, it could certainly add to your costs and make you less competitive on price than you'd like to be. The flip side of that coin, Carrie, is that if you're under collecting the tax, you're certainly putting yourself at risk with the state and local tax authorities.
So I think we get the picture that, tax jurisdiction is certainly a complex topic. So moving on to technology, how can small business owners leverage technology to manage sales and use tax?
Well, when you look at the way that companies address taxes, there's 3 common approaches that we see in the marketplace. One approach, which is probably not recommended, is to ignore tax altogether. Very few companies do that because even though they may think that it's not likely that they'll get audited, they know that there is a chance. Ignoring sales tax is the cheapest way to deal with it because the cost of managing that is near zero. The risk, though, of course, is exponentially high. Another approach that's been commonplace up to this point is the do-it-yourself model. Companies go out and do a whole host of discrete business activities, tax-related activities to maintain compliance, like researching tax rates, building tax tables in their system, researching how the items and services that they sell are taxed, running reports, filling out forms, cutting checks, paying tax authorities. That's a significant amount of effort to be compliant. And, a study was done by the Aberdeen Research Group that found that the average company spends, even in the small business category, on average, it's about $63,000 a year. And so I'm certainly not saying that that's your company, listening in on the webinar today. It may be less, it may be more. But one thing that I've seen over the last 15 years or so is that there certainly is a cost of compliance. So what companies are doing more and more is they're choosing to automate those processes because that's really the only effective way that they've been able to drive down the cost of managing tax, at the same time drive down the risk. And the challenge with taxes, at the end of the day, there's really no upside. I mean, you mentioned it earlier, Carrie. It's a non-revenue generating activity. It's actually illegal to make money collecting taxes. So the best you can hope for is simply not to lose money. It makes sense to take an approach that drives down the cost and drives down the risk. If you're a company that's thinking about, is automation a good step for me, one of the things that you can do is you can estimate tax leakage. And when you look at tax leakage, you could do a study of your own company and look at, have you been through sales tax audits? If you've been through sales tax audits, have you paid fines, penalties, and interest? What's the monetary value of those fines and fees that you've paid? That would certainly fall into the category of tax leakage. What if you've been through sales and use tax audits, but you haven't been fined? What's the cost of supporting that audit in terms of man hours and resources to do that? The other thing to look at is determining the process costs for your business. All those discrete activities that I mentioned there, who in the business does those activities, how much time does it take, how much do you pay them? Typically, you're going to build out an ROI case that using technology is cheaper and more effective. And certainly I'll put an asterisk by cash flow considerations, because if you're making mistakes with tax, one of the impacts we see from customers is that they defer payment from their customers because they're not paying invoices. They're going back and forth and trying to fix issues, or they're short paying invoices because they didn't ask for a certificate, the invoice had tax, and now they're paying it without it. So one of the trends that we see in the marketplace is, companies are turning to technology to kind of address the challenges of tax. By its very nature, it's complex, it's error-prone, it's hard to do, but it's not a competitive advantage to business anymore to be good at tax. It's very similar to why companies outsource payroll. When they get to a certain size, it just doesn't add a lot of value to the business.
So Mark, once a company does make the decision to automate, what impact is it going to have on their business?
Well, companies that utilize technologies inevitably end up saving time and effort. They're going to dramatically increase their accuracy, and as a result, they're going to drive down their risk. What companies have been able to do, because for a lot of small and mid-sized companies, there is no tax department per se. Tax is a part of someone's job or multiple people in finance that do other things for the business. So this is not typically a case where this eliminates a headcount, but what it allows companies to do is take resources that were spending some of their time on taxes, and in a lot of cases significant amounts of time, and it can put them towards activities in the business that are much more profitable. Who wouldn't gladly take a tax resource off of taxes and put them towards making collections calls or staffing customer service phones or doing things that actually help the business be better and compete and provide a good customer experience. I've yet to see a Yelp review that says, I really love working with ABC company because they do a great job with my sales tax. It's just expected that it's done correctly, and but when it's wrong, everybody's upset.
So how should a small business owner determine what to automate?
Well, there's a whole bunch of different activities that go into compliance, and typically with systems, you see three common areas where companies automate. One of them is around the calculation of taxes, and this can be a big thing. We talked about the research that goes into, going to Department of Revenue websites and researching tax rates, and then going into their accounting system like QuickBooks or NetSuite and trying to build out a set of rules in the system that apply the right calculation. And then people have to go in, and when taxes change, which they do pretty frequently, I think last year there was over 550 changes to tax rates specifically, so you got to change those in the tax tables of the system. And then you also have to think about, who are you selling to, where are they located, where are you shipping from, and are the items taxable or not? That can require some research as well. Companies are implementing automated technologies that integrate with their accounting systems so that when someone enters a quote or an order or an invoice, instead of having to look up that information manually and set it up in the system, they integrate with systems like Avalara that automatically calculate the tax and provide it back into their native invoicing system. Another common area where companies see challenges and they choose to outsource and automate is around exemption certificate management. There's technologies out there today that automate the full life cycle of certificate management. So everything from requesting a certificate from a customer to validating and storing that certificate, applying that certificate to certain purchases within the accounting system, even being able to retrieve that certificate or renew that certificate, as it expires, is all things that can be automated with technology. And the same is true on the back end from a filing perspective. On the slide here, it shows that in this Wakefield survey, they found that the average company just to file and pay their taxes was spending close to 11 hours a week, close to a week a month, just to file their taxes. The good news is that can be outsourced today as well. So companies can calculate the tax and then have companies do their reconciliations, but the way it works is similar to payroll outsourcing. The company would pay one amount to their vendor. That vendor would interface either via paper or electronically with state and local tax agencies to file and pay the taxes directly on their behalf. So really this is more of an end-to-end compliance model. It's more of an outsourced model, but this is an approach that we see people taking in the marketplace.
Great, thank you, Mark. So let's move on to that scary word, audits. What steps can small business owners take to minimize their risk of audit?
Well, one thing that I'd recommend before we even get into the slide, Carrie, is that companies do some Nexus analysis. It sounded like from our poll, half of the folks on the phone are pretty confident that they know what they need to know about Nexus. Half of the attendees maybe not so much. There's resources out there at state websites. If you go to the Department of Revenue, you can research, what are the Nexus-Creating activities in that state. Now, the research might be hard to do. It might take some time, but at a minimum, I'd suggest that companies review their Nexus policies and review the laws in the different states that they're interacting with. But for those people that maybe want a professional opinion, there's plenty of resources out there like state and local tax groups, or as a part of regional and national certified public accounting companies. They offer services like Nexus analysis or Nexus studies to help companies come up with the right tax policy. Once you're registered in all the right places, it's really imperative that somebody in the business is managing a tax calendar. In other words, they know what returns are due for what states on what forms, and they're managing to that, because failing to file a tax return can be a red flag, could create an audit scenario. Certainly another thing that companies have to focus on is reporting their sales accurately, and reporting them consistently. I've talked to auditors before where they say one of the common red flags is that companies are reporting a different sales amount on their sales tax returns than they are on documents like their state income tax returns. And that can certainly bring about some scrutiny onto a company. One of the things that we recommend companies avoid is taking excessive credits or exclusions on a return. I've talked to companies that have done use tax rebate studies where they felt on the purchases that they've made, they may have overpaid their use tax, and have done studies to figure out what those amounts are and take credits on those. In almost every case I've seen that happen, it triggers a sales tax audit from the state before they actually pay that refund. Filing returns with errors can certainly be a red flag. One of the biggest things about putting you in an audit cycle is having made mistakes in a prior audit. So it's really important, if you've been through an audit, to understand that states have different look-back periods. They have different statutes of limitations. So it might be 3 years or 5 years or 7 years. But almost certainly if you're found making mistakes, if you pay fines, penalties, and interest, at the end of that look-back period, you're probably due for another audit where the state's going to audit that prior period. Certainly using exemption and resale certificates incorrectly, if that's found out, that can be a trigger for an audit. One of the big no-nos that we see a lot in our business is companies that fail to report use tax create audit issues for themselves. So, if they're only filing a sales tax return, or if they're filing a combined sales and use tax return, but they're not accounting for the amount of stuff that they bought that didn't have tax charged on it, that could be an audit trigger, and it could really hurt them in the event of a sales tax or a use tax audit.
Thanks, Mark. Now let's detail out a little bit what small business owners can proactively do to avoid sales tax audits?
Yeah, and I kind of mentioned this one on the previous slide, but Nexus studies are important. You know, a story that comes to mind is there's a company in Oregon that, Oregon has no sales tax, and they found that individuals in Washington state, in the southern part of the state, were driving across the border to buy mattresses from this mattress dealer in Oregon because they didn't have to pay sales tax. A mattress is can be a pretty expensive item, and they were avoiding it. The owner there, Sherry, got to thinking, it'd be good if we expanded our market into Washington. We have a bit of an advantage here. And the mistake that Sherry made was she hired drivers and bought vehicles and started doing deliveries like other mattress companies into Washington. And what she failed to understand was that going into someone's home, installing a mattress, setting it up on the frame and taking away their old mattress was considered installation of tangible personal property. That was a Nexus-Creating event in Washington. State of Washington found out about it, audited Sherry's company, Mattress World. They ended up shutting down. They had an audit fine of $1.4 million. They tried to work out payments they could basically never recover in their business. And it's not because Sherry was trying to do anything nefarious or avoid collecting taxes. She just failed to do the research to understand, this activity is creating a connection and requires her to register and collect taxes in those states. So certainly I'm not trying to scare you, but that's the real world scenario if you're found to not be collecting taxes. A Nexus study is easy to do to figure out if you do have exposure. If you have exposure, there's ways to deal with it. But I'd encourage the people on the phone to stay up to date with rate, rule, and boundary changes. There's a lot going on. Tax rates change. It's a pretty fluid environment out there, so it requires some constant upkeep and maintenance to stay in compliance. Certainly, we'd encourage people to report their consumer's use tax. Avalara, as a technology company, we talk to a lot of startup businesses or brand new businesses, and we'd recommend that you do the research to be compliant from day one. I mean, certainly down the road, there's companies that find out, we have exposure because we didn't do the right things, and there's ways to try and mitigate that, like voluntary disclosure agreements with states, where you can potentially negotiate the amount of tax that you're paying, to come clean, but it's always a stressful process. It's never a fun process. If you're in the position where you're, starting a new business or you're pretty new in business, do the homework to be compliant from day one. And we highly recommend automating with technology. Every company reaches a point where the do-it-yourself model becomes cost prohibitive. Why within your business should you, put people on the tasks of managing tax? At some point, you'd be, as you grow, you're going to be creating a tax department around sales tax, which certainly is unnecessary. Make sure you have an understanding of your filing requirements. When you're doing your taxes, make sure that you're doing research to get the taxes right for your customers. I mean, one unintended output of getting the taxes wrong is sometimes larger companies have gone through class action lawsuits because they're charging the wrong tax rate or they're charging tax on stuff that shouldn't be taxed. Make sure you're researching the items and services that you're selling and how the state interprets those as far as whether or not they're taxable, because those can vary a bit state to state. Keep detailed sales records, and if you're not charging tax, maybe you're selling to an exempt customer or you're selling an item that's not taxable in that state, make a note of it so you understand why you decided not to charge the tax. That's going to help you in an audit. And then certainly make sure you have a way for ensuring that you have good certificate documentation. The certificates that you file or have on file are completely filled out. They're on the right form. There's current company information on them, and they're not expired. Again, this is not an exhaustive list, Carrie, of things that you do to be compliant, but it's some common things that we see companies miss, and it can be costly to them in the event that they do go through sales tax audits.
Thanks. That's helpful. Before we move on to the next topic, I just want to remind everybody, if you haven't already done so and you have questions, feel free to submit them via the Q&A widget, and we're going to be addressing some of those very shortly. We haven't touched on services today, Mark. Can you explain how services fall into the sales and use tax spectrum? Why are services red flags to auditors?
Well, so services is an interesting area. when you're selling products, it's generally assumed that items, products, tangible things, stuff, in quotes, is taxable, unless there's a law, in a state or a jurisdiction that says we don't tax, we don't tax, food, or we don't tax kids' clothing or whatever it is. It's assumed that those items are taxable unless otherwise specified. The opposite is actually true with services. So services are generally assumed to be non-taxable unless a state has a law specifically enumerating that type of service as a taxable event. So, one of the things that we certainly see is that the distinction between services related to tangible personal property, TPP, like installation, repair, warranty services on things like equipment, could be taxed differently than real property services like construction or remodeling services or things like that. Add to that a third category, a third class of services that can be taxed differently, which is professional services. So consulting services or computer services, things that are in the professional service category can be taxed differently in different states. One of the biggest challenges with services is that as states face budget deficits, expanding the tax base by passing laws to tax services is highly desirable. Minnesota was one of the first states in recent years to pass a business services tax a few years ago. As California has gone through their budgeting process, I know it's been talked about the amount of revenue that they could bring into the state simply by applying the normal tax rates on tangible personal property to services as well. There's some complexity there, though, Carrie, as well, because different states handle it differently. There's some states that tax a lot of services, like Connecticut, Hawaii, New Mexico, South Dakota, West Virginia. On the other hand, you have states that don't tax many services, like Alabama and Florida and North Carolina, Oklahoma, and Utah. The further complication of this, and one of the things that we see is commonly happening in the marketplace, is people are bundling things more and more, and that makes it even more difficult to manage. But services can be taxed. A couple of examples, if you attend an amusement park, the admission for an amusement park is taxable in 34 states. Cable television service is taxable in about half the states. There's over 40 states that tax telecom services. So, there's a whole host of services that are taxed differently state to state. The research, again, is a little bit more complex because it's not the assumption that those things are taxable unless otherwise stated. It's the opposite. You have to do a little bit more searching to figure out what kinds of services are taxable in a state.
All right. Well, now we're going to open up the Q&A portion of the webinar. We hope to get to all of your questions, but if we don't during the event, we will try our best to respond afterward via our sales and use tax thread on the Manta community, which is linked in the resource list, along with a bunch of other great resources for you today. Additionally, you can navigate there by visiting community.manta.com/ and clicking on the banner ad at the top of the page, which is illustrated on this slide and highlighted in a red box. So to kick off the Q&A portion of the webinar, Mark, I'd like to ask you a question about all the variance from state to state. From your position of expertise, is there any chance, do you think, of the federal government developing a consistent set of regulations of sales and use tax for the U.S. as a whole, rather than the confusing set of state-by-state laws we have now?
Well, Carrie, they've tried that. They haven't been so successful yet. There's actually a consortium of 24 full member states in a group called the Streamlined Sales Tax Initiative. And those 24 states have taken steps to simplify the collection of tax for businesses. And they've done some interesting things. If companies join Streamlined Sales Tax, there's one registration form to register for all states in that group to collect taxes. They've made it a little bit easier as far as the definitions of items. Different states have had different definitions of what's a food or what's a candy. The Streamlined Sales Tax Initiative has agreed upon, those 24 states have agreed upon the definitions of items and services. So, for example, the difference between a food and a candy in those 24 states is the same. If flour is an ingredient, it's considered a food. If there's no flour present, it's considered a candy. But even still, with the progress that they've made, Carrie, it's not as uniform as it could be. They all have different impressions of, or different interpretations of how you tax that food or candy, even though they agree on the actual classification. They've made some steps, towards providing a simplified electronic return that if you join Streamline Sales Tax, you can use for all the states. But that's half the states, and you have a lot of states holding out, like California and Colorado. Most of the big sales tax states like New York and Florida and Colorado and California, they want to do it their own way. So, I would imagine there's going to be, some changes that simplify things and make it more uniform. But I think it's a pretty tall order to go from the system we're at to actually get there. That takes a lot of time.
All right, thank you. Well, I have another question for you here. What do I do with a new client who should have been charging Michigan sales tax but never has? He has given me a list of what his total is in-state taxes are. Won't the penalties be huge even though the tax owed is less than $500 a year?
It could be. One of the things to definitely look into in this situation is look into voluntary disclosure agreements. Most states allow a company to come forward anonymously. They've realized they have, not honored their obligation to collect tax. And what that typically allows for is some flexibility around, one, negotiating potentially the period of the uncollected tax that is needing to be repaid. Sometimes that can be negotiated. Also, fines and penalties and things like that could be negotiated as well. So if you haven't provided that type of service to your client yourself, you may want to talk to a state and local tax group. Like I said, there's companies out there that specialize in sales tax consulting. CPA firms at the regional and national level typically have those capabilities. Technology providers typically have it as well. If this is something that you'd like help with for my company, reach out to Avalara. You can contact us, at avalara.com, but we oftentimes help companies do voluntary disclosure agreements to minimize the exposure and minimize what they're paying to come clean with the state. So we'd love to talk to you about it if we could be helpful.
Thanks, Mark. Next question here. How often do we need to obtain updated resale certificates?
That's a great question, and that is probably a business process question. Now, there are some states that have expiration dates associated with exemption and resale certificates. I'm thinking of Florida, like if you haven't made a sale to a customer in a year, you have to collect a new resale certificate. So some states have expiration dates that you need to pay attention to, and at the end of that document's life cycle, you need to go collect a new document if you're continuing to do business with them. But the other thing that companies, we see them starting to do is implementing their own business rules around certificates, because there are states that the documents don't expire, but the asterisk there is that as long as they contain current company information. So how do you know, with all your customers who changed their address last month, or, the person that signed the documents no longer with the company? Because of that, we see companies reaching out for new certificates across the board every 2 or 3 years, just to make sure that they've incorporated any changes to the businesses that they work with, so they have current customer information on those certificates. So generally speaking, whether it's every couple years or every 3 years, we see customers, expiring their own certificates to make sure they've got current stuff.
Thank you, Mark. The next question is, am I required to pay use tax if I drop ship materials to a customer who is out of state, but in a state that I know that I have Nexus?
I have to think about that question a bit. There's a lot going on there. So
right?
Can you repeat that to me, Carrie? Yeah.
Yes.
I'm going to take some notes on this. Yeah.
Absolutely. Am I required to pay use tax if I drop ship materials to a customer who is out of state, but in a state that I know that I have Nexus?
I guess my question back to that question is, because normally I would think that, and I know there's a whole bunch of, asterisks in odd situations with sales tax, but normally if I were selling a good outside of where I'm at, selling it out of state, but in a state where I have Nexus, normally I would want to charge the tax from my customer. Now, a couple of things to consider on that transaction is, one is the customer exempt or not? Because that may make it an easier transaction if they're, doing resale or some type of organization that's exempt. But the other thing to look at is the type of item or service that you're selling. Is that taxable in the state that they're in? If the answer is yes, typically you would want to reimburse yourself the tax by charging it to your customer and then paying the tax in that state. There are some scenarios, and I don't know if you're in the construction field, where when you sell certain things, you may be considered the customer if it's related to a particular type of job, and you would be responsible for the use tax. But maybe this is one that we should expand the conversation on. You're welcome to reach out in our forum, and we could talk about it a little bit more as well.
Thanks, Mark. Here's another one. I think you touched on it briefly, but maybe you can expand a little bit. If our company buys a product and pays a sales tax for it and then resells that product to a customer, do we need to collect another sales tax?
Well, that's kind of the opposite side of this drop ship scenario. It sounds like you're buying something that then is being shipped to a customer, and you're paying tax, and then you turn around and sell it to your customer. The thought process would typically be, from a taxation perspective, is it worth your while to go register with the state to get an exemption or resale certificate in that state where your customer is, so that you can give that to your vendor. They don't have to charge you the tax, and then you can turn around and charge the tax from your customer. So this may be a scenario where you may want to evaluate how much business do you do in that state that your customer is located in. Is it worth your while to go ahead and register there and get exempt status from your vendor, or get exempt status from the state to give that to your vendor, so then you could be responsible for collecting the tax?
Here's another question for you, Mark. Where can I go to find the sales tax regulations in Virginia for services? I own a maintenance and repair business, and I'm not sure what services are taxable.
Typically, what you're going to want to do is go to the Department of Revenue. So I haven't been out to the Virginia DOR recently. That is firmly fixed in my mind. But I'd start with the Department of Revenue for the state. Typically, when you get to the State Department of Revenue, you'd want to go to the business services area, and specifically within the business services or business area, business tax area, I should say, is going to be information on sales and use tax. And typically there you can get to either an area of letter rulings or definitions of different types of taxable events. But if that's something you're interested in a bit more, you're certainly welcome to post on the forum, and I could do some quick searching and see if I could provide you with some helpful links to do some research on that.
Thank you, Mark. Another question for you. I'm a landscaper. Do I need a sales tax permit?
Well, it depends on the way that your service is defined, where you're providing those services. So if it's a state where landscaping services are taxable, then yes, a company would want to register to collect the sales tax. That may not be the case. There are states that don't tax many services, and if you're in one of those and landscaping is non-taxable, you may not be required to register to be a taxpayer in that state. One of the things that I'd say is, if companies are concerned with this, certainly the intention of the questions is not to give tax advice specific to your business. I'm providing you some details as far as the fundamentals of tax and how to apply that information, or how to understand that information. But in applying it to your business, it may be worth a quick call to your your CPA or your state and local tax group that's local to you, where you could ask that question and provide them some more details of what you're doing, and they could give you a conclusive answer.
Thank you, Mark. We actually have to wrap it up now, the Q&A portion of the webinar, but I encourage everybody to go over to the community, which we have highlighted on the slide here so you can easily find it, and ask Mark any other follow-up questions that you might have. Be sure to go to the Manta events link in the resource page to sign up for our October webcast series. Each is only 10 minutes long, and the topics are 10 sales tax rules small businesses can't ignore, sales tax tips for online sellers, which will cover Amazon laws and the Marketplace Fairness Act, and avoiding sales tax audits, and what to do when things go wrong. Thanks for attending, everyone, today.